What if one ETF quietly handed investors a 46% return last year, while the S&P 500 delivered 30% and the FTSE 100 just 23%? That ETF is the iShares MSCI Emerging Markets ETF, and it's posting one of its strongest performances relative to developed markets in nearly a decade. So what's driving this surge? And more importantly, should you be paying attention? In this video, we make the case for investing in emerging markets and show you exactly how professional investors approach it. Stay with us to the end. Welcome to Simply FinCon, where we cut through the noise to bring you clear insights and actionable ideas for smarter, safer investing. If you find this valuable, hit subscribe so you never miss an update. And a quick note before we dive in. Everything you're about to hear is for educational purposes only. It is not personalized financial advice. Your risk tolerance is unique to you. And as always, past performance is no guarantee of future results. Now, let's get into it. Let's start with the macro picture. Emerging markets, think China, India, and Brazil, are forecast to grow at 3.9% GDP in 2026, more than double the 1.8% projected for advanced economies. What's fueling that? Young, fast-growing populations, rapid urbanization, and a technology revolution that's allowing these countries to leapfrog legacy systems entirely, from mobile payments to AI supply chains. This isn't just catch-up growth. It's structural and it's accelerating. Growth in the economy is one thing, but what matters to investors is earnings growth. And here, emerging markets are equally compelling. Analysts project roughly 17% equity earnings growth for EM in 2026, compared to around 12% for the S&P 500. The drivers: a surging middle class, domestic consumption, urbanization, and East Asia's growing role in global AI supply chains. Of course, these are forecasts, not guarantees, but the direction of travel is hard to ignore. Now, let's talk valuation, because this is where the story gets really interesting. Emerging markets currently trade at a 30 to 40% discount to US equities on a forward price to earnings basis. We're talking 13 to 14 times earnings for EM versus 20 to 22 times for the S&P 500. And when you adjust for growth using the PEG ratio, EM comes in at roughly 1x, compared to 1.8 to 2.0x for the US. In other words, you're getting more growth for less money. That's what investors call a margin of safety. These are valuation observations, not investment advice, but the numbers speak for themselves. Here's a striking fact. Emerging markets represent only about 11% of global market capitalization, yet they account for the majority of global GDP growth. That gap between economic weight and market representation is exactly where long-term opportunity lives. Add in favorable demographics, rapid urbanization, and improving corporate governance, and you have a multi-year structural tailwind. What's more, EM earnings are increasingly keeping pace with the S&P 500, a trend that, if it continues, could close that valuation gap significantly. But let's be honest, emerging markets are not for the faint-hearted. Higher volatility, currency risk, geopolitical tensions, political instability, liquidity constraints, and index concentration are all real considerations. Here's a concrete example. A 20% gain in a local stock market can shrink to just 5% after a 15% currency depreciation. That's not a hypothetical. It happens. Understanding these risks isn't optional. It's the price of admission for accessing this growth. So how much should you actually allocate? Most new investors start small, around 5%, just to get a feel for the volatility without losing sleep over it. More experienced investors typically target 10 to 15% within a long-term portfolio. The golden rule? Only commit capital you won't need for at least 10 years. Emerging markets reward patience. They punish short-termism. Keep that in mind before you size your position. When it comes to implementation, most investors cap their EM exposure at 5 to 15% of their equity portfolio, enough to move the needle without taking on undue risk. For core holdings, ETFs like VWO and IEMG are popular choices, highly liquid, low cost, and broadly diversified. Rather than trying to time the market, consider dollar cost averaging. investing a fixed amount regularly to smooth out volatility, and always keep an eye on macro factors and fees. In emerging markets, costs compound just as fast as returns. So here's the bottom line. Emerging markets offer something rare: genuine growth potential, attractive valuations, and real diversification benefits, all in one asset class. But they demand discipline, small, deliberate allocations, a long time horizon, and the composure to stay the course when volatility spikes, because it will. The investors who've done well in emerging markets aren't the ones who chased returns. They're the ones who stayed patient, stayed diversified, and let compounding do the heavy lifting. Are you already invested in emerging markets, or are you still on the fence? Drop your thoughts in the comments below. We'd love to know where you stand and what topics you'd like us to cover next. This video is produced by Simply FinCon and is intended for educational purposes only. Nothing presented here constitutes financial advice or a recommendation to buy or sell any security. All investments carry risk, including the potential loss of principal, and this is especially true in emerging markets. Please consult a qualified financial advisor before making any investment decisions. Thank you for watching.